Welcome back. In the first video, we discussed what is a partnership and how a partnership is formed. In this video, we'll look at the operations of a partnership and how those operations impact tax consequences and impact contributions to partners. We'll also look at the tax consequences for partners for contributing money to a partnership. Now remember, partnerships are operated based on the theory of the entity and the theory of the aggregate. As an entity, a partnership reports their information to federal and state taxation entities, but they don't pay taxes on their operations. Those taxes pass through to the aggregation of partners who comprise the partnership. The partnership is, however, responsible for all taxes that any other business would be liable for. This includes sales and property taxes, employee taxes, Social Security and disability taxes, unemployment taxes, and where applicable, franchise taxes. As an aggregation of partners, partners are responsible for paying taxes on partnership income. Because any person under the law can be a partner, the consequences of partnership activities can be taxed on any of a number of income tax forms. For example, individuals pay taxes and file taxes using the Form 1040, and corporations file and pay taxes using Form 1120. There are certain deductions that are not allowed for partnerships. We'll talk about some of them in a little bit more detail later. Net operating losses. The loss itself goes back to the shareholder or the partner. The dividend receives deduction. The dividends received deduction only applies to corporations. And payments made on behalf of a partner using partnership funds. Any such payments, such as alimony, medical expenses, are considered income and taxed as ordinary income to the partner. Guaranteed payments, which are payments made to a partner for services performed by the partner or for the use of the partner's capital are akin to salary or interest in any other business form. These can take a fixed dollar amount or a percentage of capital used. On pages 2 and 3 of the Form 1065, the partnership describes the partnership's activities and general information about the partners. Page 4 is the Schedule K. This schedule summarizes the partnership's ordinary income and loss, the separately stated items, and any other information that the partners need to prepare their returns. The fourth page of the Informational Partnership Return reports Schedule K, which is the aggregation of partnership income, expenses, and credits that are each required for the partners to report their individual information. Also included on the form, those items necessary for the partners to prepare a complete and accurate income tax report, including the aggregated partnership share of tax credits, information used to make various tax and tax credit calculations, such as the foreign tax credit and the self-employment tax, information that the partners need to compute their own basis, and information the partner needs for other calculations and limitations, such as the qualifying business income deduction or other interest expense. Now, interest expense is subject to some limitations, generally based upon how and why the underlying debt was incurred. For example, business interest has a limitation. That limitation is outside the course and scope of this class, but it is important to know that any of the business interest exclusion that you don't use in one year can be carried over to the next. On page 5, you begin to see the separate schedules relating to the partnerships and the partnership reconciliations. The first of these is Schedule L, just like we saw on the corporate tax return, which reports the accounting basis balance sheet. The next part is Schedule M1. Just like we saw on the corporate return, this shows the reconciliation of book and tax income, where taxable income is the net of the partnership's ordinary and separately stated income and expense amounts, computed before deducting partnership guaranteed payments. It's reconciled to book income. Small partnerships use Schedule M1, and large partnerships use Schedule M3, just like we saw with corporations. Schedule M2 reconciles the partner's capital, including the beginning and ending capital account balances. It takes into consideration the contributions to and distributions from the partnership, as well as the partner's shares of income, gain, losses, and deductions. Now, it can be computed using a tax basis, using a GAAP basis, or using the Section 704B book method, as long as the same method is used on the M1 as it is on the partner's individual K1s. And that's a good transition to the Schedule K1, which is the partner's allocation of partnership items. In a sense, this is an individual partner's W-2. It shows information about the partnership, their employer. It shows individual information about the partner. And then it shows information that gets used and plugged into the partner's own tax form. An important component of this is the guaranteed payments for services and capital. Guaranteed payments are payments made to partners in exchange for services provided to the partnership or the use of their capital. So what do we mean by partnership debt? There's typically 3 kinds of debt referred to in partnership activities. Recourse debt is debt that the partnership incurs for the partnership's benefit. It's debt for which some or all of the partners are personally liable. It's split amongst the partners in the ratios described. Non-recourse debt is debt for which a partner is personally liable. This is typically collateralized debt. It's debt that's incurred to obtain a specific asset. Qualified non-recourse debt is that portion of non-recourse debt that is subject to limitations, such as if you're a limited partner. Now, of course, this is tax law, so some exclusions may apply. You can't reduce your liability or reduce your partnership basis any more than your basis in the partnership. The lowest your basis can get is 0. Passive activity losses are subject to those limits set by the tax code, and net operating losses can't be carried forward or back in partnerships. Finally, distributions from partnerships. As we talked about, these reduce the basis of the partner's share by taking money from their ownership interest and transferring it to the partner. Such transactions generally don't carry a gain unless they exceed the partner's ownership interests, their basis. There's 2 different types and subtypes of distributions. The first is based on whether the partner is still in the partnership. If they're an active partner, it's a current distribution. But if the partner is leaving the partnership or the partnership is dissolving, it's a liquidating distribution. The second category of partnership distributions is based upon whether the distribution mirrors the partner's ownership percentages. If it does, then it's a proportionate distribution. If the distribution is intended to reallocate the different partnership bases and ownership percentages, then it's a disproportionate distribution. This represents the aggregate theory of partnership, which says that a partnership is made of a bunch of individuals acting as one, and they're entitled to their original contributions. 3 types of property can be distributed to partners when they're receiving their partnership distributions: cash, unrealized receivables and inventory, and property. Cash can include cash itself, but also the reduction of liabilities and the receipt of marketable securities. As long as the cash distributions do not exceed the partner's basis in the partnership, the partner does not have to record a gain. The second type of distribution is unrealized receivables and inventories. These are receivables that would trigger ordinary income when received. And inventory, which is broadly defined as any partnership assets except cash, receivables, or depreciable property. Again, as long as these properties do not exceed the partner's basis, the partner does not have to record a gain when they receive the distribution. And finally, property. Anything that's not included in cash, inventory, or receivables. Now, when distributions are being made, they're made in that order, and the gain or loss provision is considered in that order. You'd first evaluate the effect of a cash distribution on the partner's basis, then the effect of an unrealized receivable or inventory distribution, and then a property distribution. The biggest difference between a non-liquidating and a liquidating distribution occurs in the property category. It's allocated based on cash, unrealized receivables and inventory, and then property. But if there's still property left to be distributed, it takes the value of whatever ownership amount the partner still has left. This concludes this lecture. On Wednesday, I'll be teaching you how to work through some of the problems related to partnership bases and distributions. Until then, be well and stay distant.